everyone. We're just going to let everyone settle in for a few seconds. And while everyone's settling in, I just wanted to, say hello and thank you for joining us this afternoon. And then I also wanted to ask, if you, just to get kind of used to using the chat section of your GoToWebinar control panel, feel free to let us know, type in where you're tuning in from, and we'd love to hear what your financial New Year's resolutions are. And I was talking to Charles before about I'm turning 30 this year, so I have to think about I have to get serious about my investments. Not that I wasn't before, but I think it's kind of lit some fire into my butt to diversify my portfolio a bit more. I'm trying to get away from just all large caps, so kind of trickle in that small and mid caps, and then obviously committing to regularly monitoring my portfolio. So, maybe at each quarter mark, taking some time to make sure I'm staying on top of my financial goals and all that kind of good stuff. But Charles, do you have any resolutions that you're making this year?
Yeah, I think financially, one of my resolutions is to consolidate accounts. Like a lot of people, sometimes you have account creep. In my case, I have a bunch of separate IRAs. I really just need to combine them into one single IRA. And fortunately, they're with the same brokerage firm. But I think many of us over time have end up with more accounts than we really need. And it's good to do some house cleaning, so to speak.
Oh, that's smart. That's good. That's a good financial resolution to make. You got all year to get going now.
Absolutely, absolutely. I'm not behind yet.
That's good. 7 days in.
Yes, I'm okay.
All right, well, it looks like everybody's getting settled, so I think, we'll go ahead and get started, and then as people kind of tune in, I'll try to reiterate as much as possible, the important notes and things that I kind of cover in the beginning. I'll try to trickle in later down the presentation as well. But first and foremost, hello and welcome to this afternoon's webinar, Beyond High Yield, Smarter Dividend Strategies and 2024 Portfolio Review, led by Charles Rotblut. And thank you so much for joining us, like I said earlier, and we're happy to have you all here. My name is Jenna Brashear, and I'll be your host for today. I want to first off welcome, to our second day of our Model Portfolio Review Week 2025. This is, of course, our favorite week of the year at AAII, and we're thrilled to have you join us on all the fun. And so you can join us each day this week for a fun deep dive into one of our model portfolios. Yesterday we did shadow stocks, today is dividend investing, and tomorrow is growth investing. And in each presentation, we'll take a look back at each portfolio's 2024 performance. We'll celebrate the stock wins, identify the challenges we faced, as well as share our goals and insights as we set out for an exciting 2025. And if you want to register for more events this week, please visit AAII.com/webinars to sign up. But before we begin, I do want to go over a few things before we get started into Charles' presentation. I want to remind all of our webinar viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus is not able to give personal advice. Every investor is different. That's why our goal with each broadcast and article is to educate you on how to make better financial decisions. And you can please keep an eye out on your chat section throughout the webinar. I'll be putting in helpful resources, key information, and of course, any special offers that we're releasing today. And if you have any questions for our speaker during the presentation, you can submit them anytime using the questions section of your GoToWebinar control panel. And then once our presentation concludes, I'll select a few for Charles to answer, and I'll try to stump him like I did with John yesterday. Although John didn't really get stumped, even though we had a lot of great questions, and I really appreciated all the people who engaged with us throughout that webinar. And then if your question isn't selected for the broadcast, feel free to email us anytime at members@aai.com. And I did place a handout of the presentation slides in the handout section of your GoToWebinar control panel, which is located on the right-hand side of your screen. It will also be emailed to all who attended today. And if you would experience any issues with the audio or video of the webinar, please consult the GoToWebinar website for support at gotowebinar.com. And just a friendly reminder that this presentation is recorded, and a replay of the webinar will be sent to all who attended today. It's also available with the PDF earlier next week at aai.com/webinars. And of course, for new viewers, we always like to give a little background about our organization. The American Association of Individual Investors is an independent nonprofit corporation formed in 1978 for the purpose of assisting individuals in becoming effective managers of their own assets through programs of education, information, and research. And in this presentation, Charles will go into this a little bit more, but I want to just give a couple bullet points on what kinds of things we will cover. So we'll cover how to identify companies poised for strong dividend growth in 2025 and beyond, how the DI approach identifies fundamentally strong companies trading at attractive valuations, and then we'll go over the new candidates now appearing on the DI ideas list. And of course, we have a special offer. I mentioned it yesterday, but we have a special offer for today's attendees. So stay tuned for all the details. But attendees will be able to use a special promo code to receive a pretty big discount on any AAII premium newsletter that we feature this week during our event. And you can visit AAII.com/webinar-week. And then don't worry, I will add that to the chat momentarily so you can easily access. But with that, I don't want to take up too much more of the time, so I'd like to hand over the presentation to Charles.
Thanks, Jenna. I appreciate it. Hi, everyone. First, I want to start off and wish everyone a very happy 2025. I hope the new year is healthy and prosperous for you, and most of all, a lot of fun. So today, we're going to talk about dividend investing. I'm going to talk a little bit about the market as well. Give you a quick overview here. Oops, as we go backwards. So my keyboard's going back a little bit here. So here we go. There we go. So just a little agenda of what we're going to go today. We're going to discuss 2024, provide an overview of our dividend investing platform. I'll explain to you why we focus on dividend growth, go a little bit over the outlook for this year, and then we'll show you some key features of dividend investing, including the ideas list that Jenna mentioned. So one thing I want to start off with is just the performance of the S&P 500. This is what I plotted really was 3 indexes on here. So I plotted the basically S&P 500 ETF, the IVV, the iShares S&P 500 ETF. Performance is the same as if I use the Vanguard or the Spider. I plotted the equal weight, the RSP, which tracks all the stocks in the S&P 500, but it equal weights them instead of market cap weights them, and then the dividend aristocrats, which are companies held within the S&P 500 that have raised their dividends for a minimum, I believe, of 25 years or longer. As you can see here, the market cap weighted index did extremely well. The IVV did extremely well relative to the average stock or the medium stock in the S&P 500. Again, same indexes, just different weighting. And the reason why is that the S&P 500, its returns were driven by a very small number of stocks. One stat that I saw that really jumps out to me, and this is from S&P Dow Jones Indices, NVIDIA accounted for 22.4% of the S&P 500's total return. That's one stock out of 500 stocks accounted for more than 1/5 of the S&P 500's return last year. And the reason why I point that out is when you look at the S&P 500, it's extremely concentrated. This chart's from JP Morgan. And what you can see here is the S&P 500 is the most concentrated it has been in decades. What it means is that if you look how much the top 10 stocks account for the S&P 500, it literally is the highest we've seen in decades. And because the S&P 500 is market cap weighted, the more the largest stocks have, more influence the largest stocks have on the S&P 500's returns, the more the index's returns overall are going to be driven by those stocks. So if you look at something, say like NVIDIA, and then you get on a list to a smaller stock, we could talk about Abbott, we could talk about Pfizer, certainly large companies, but nowhere near the size of your Apples, your NVIDIAs. They're not influencing the index very much. So when you see the S&P 500 and you look at other stocks and you wonder, well, why is that stock trailing the S&P 500? It's because most stocks are trailing the S&P 500. It's very concentrated. And if you're a contrarian, this is a sign that perhaps it's time to look beyond the so-called Magnificent Seven technology stocks. Look beyond it because there will be opportunities forming. Now, when do we see that pendulum switch? If I knew that answer, I'd be giving this presentation from a nice warm beach in Tahiti instead of a chilly Chicago. So we don't know what's going to happen, but we can tell that the market itself is very disconnected from what historically we've seen. The other thing that happened this year was the Fed started cutting interest rates, as you all know. The Fed cut interest rates by 50 basis points in September, 25 basis points in November, and 25 basis points in December. This is a small amount of cuts relative to the increases the Fed previously made. As everyone here well knows, the Fed was very aggressive in terms of raising interest rates to get inflation under control. And now it's very slowly backing off the high interest rates. But what's interesting, even though the Fed raised interest rates, bond yields rebounded. So this right here, this is actually the 10-year bond. And you can see right here, let me go back here. You can see right by here, right at the edge, the left edge of this green box here, I'm pointing with my mouse and you all probably cannot see my mouse, but right around September 24, 2009, bond yields kind of bottomed and then they rose back up. The higher yields basically provide more competition for dividend stocks because some investors might look at money market accounts or say short-term bonds and think, well, I can get a higher yield in those than I can in dividend stocks. And so that creates some competition to it, even though when you buy a short-term bond, you buy a money market fund, you buy a CD, you have no capital appreciation. Yes, you get a better yield, but when you buy dividend growth stock, you get both the yield, and that payment by the yield will increase over time as the company raises its dividend, as it grows its dividend, but you also get capital appreciation on the stock price. So you can't just do a comparison of yield to yield because it's not apples to apples. You're taking a growth assets with a capital preservation asset, and they're two very different things. But one thing we have seen with the bond yields is they have gone up. It does signal some expectations by bond traders about inflation staying at current levels for longer. And we're also seeing this take place in the mortgage rates too, where mortgage rates dipped and then they jumped right back up. So the one thing I'll point out is when you look at the DI portfolio, we talked about yields. We look at the IVV, we look at the IYY. It's an iShares ETF. It's the US Dow Jones ETF. It's a broad market ETF. So it's still market capitalization weighted, meaning the largest stocks have the most influence on the index, but rather than staying with the top 500 stocks, it tries to encompass the overall market. And this is why we use it as a benchmark instead of the S&P 500. But what you can see on this chart here is the market itself right now is yielding 1.1%. The DI portfolio is yielding 2.6%. So the DI portfolio is giving you more than double the yield of the market. Now, some of you might look at 2.6 and say, well, that's kind of a low yield. And on an absolute level, it's not what we consider to be juicy, but yields are determined by market levels. And we've seen the market make a big run upwards. So as prices rise, yields will go down, everything else being equal. And so I think it's really important to pay attention to relative yields, what yields are available in the market environment you're currently investing in, not absolute yields, not what you'd like to invest in, because what might have been a pretty typical yield in one market environment can actually be a very high yield in a different market environment. In today's current market yield, a lot of the higher yields, maybe they're 4, 5, 6%. You do find some quality stocks in there, but you also find a lot of stocks that are perhaps high yields because traders perceive risk. And certainly when you start going to higher levels, in terms of 7, 8%, that high yields often come in with a lot of risk. And so even though you might get that high yield, you're also running the risk of a big drop in the stock price. Now, the other thing I'll point out here when we start looking at yields here is that it's interesting. I have this in an addendum here, but when you look at dividend increases, last year was actually a lower year in terms of number of companies raising their dividends. In fact, it was the second fewest number of dividend hikes that we've seen since the Greek financial crisis of 2011. Only the COVID-19 pandemic year of 2020 saw fewer increases. Still a lot of companies raising their dividends, but we saw fewer companies doing it this year than we have in the past. And I do have an addendum to the slides. They're in a downside. When you can download them, the slides, and you'll see them in an addendum to my slides where I actually have that plotted out. But let me move on here to the dividend investing portfolio and kind of talk to you about why what we're doing, and I'll kind of explain to you why I'm putting out some of the things that I've been pulling out. So the dividend investing, we look for three pillars. We look for a stock's dividend valuation, its dividend growth, and its dividend strength. And these grades are just like you had in school. A's make your parents happy, F's will get you grounded. So we want stocks with A's or B's, and we avoid stocks that have grades of F. And all these grades can be accessed on the dividend investing website. Now, I will point out these grades are different than the grades you will see in the A+. And with VMQ, these grades are specific to dividend investing, and they're specifically tied to dividend investing stocks. So what's behind these grades? So first of all, our dividend valuation components. When we look at dividend valuation, we put a lot of emphasis on relative dividend valuation. So what that means is we're looking at the stock's current yield, and we're looking at the stock's 5-year average yield. So the 5-year average yield is basically what is the average yield over the last 5 years. And we want to buy stocks whose current yield is above its 5-year average. So we're basically looking for stocks that are trading yields higher than investors have typically been willing to accept the stock for. So in other words, since yields and valuations are inverse, higher yields suggest bigger valuations. We sell stocks when their yield gets too low, meaning when we see their yield fall below the typical range that investors have been willing to accept. At that point, say if investors have been willing to accept a range for stock, say of 1.5% to 2.5%. When that stock's yield falls to 1.4% or 1.3%, that tells us that yield's lower than investors have been willing to accept over the past 5 years, and that perhaps the stock is overvalued. We also do consider shareholder yield. Shareholder yield is the dividend yield plus the buyback yield. And it's an additional valuation measure because a lot of companies do pay dividends, they do grow their dividends, but they also like to return capital via share buyback. So we do look at both. And the ideal company is financially strong enough that it pays a nice dividend, has a strong growth rate, but it also buys back shares because buying back shares increases, when a company buybacks its shares, it increases the ownership percentage you have of that company. So let's move on here to, and I do explain relative yield right here. So let's move on to the growth components. So the growth components, we want companies in DI that have the ability to not only pay their dividend, but the financial ability to grow their dividends. And these criteria tell us that the company has this trait. As you can see here, we have 4 different components here. Let me go through these. So our growth components, we actually look at our dividend strength. So our dividend growth components, we're really, as I said here, as you can see here, we're looking to see whether the company has the financial ability to do so, and also whether or not it has the intent to do so. And I provide more details about this in the slides you'll have afterwards. But let me go through the dividend growth components here. So in terms of, let me go back to here for 1 second, sorry about this. So you can see our dividend growth components here. I go into more detail in the addendum, but basically we're looking for cash flow operations, meaning the company has enough cash generated from its normal business operations to pay dividends. We're looking at return of assets. Is the company being an effective manager of its assets and using those assets to drive sales? But we also look at dividend growth. Has the company historically raised its dividend? So with cash flows telling us the company has the ability to raise its dividend, a history of dividend growth says it has the intent. So for our dividend growth components here, you can see them right here. And what we're basically looking on again is companies that are strong enough to, we're looking for companies that are strong enough to sustain their dividends. And how do we tell if a company's strong enough to sustain its dividends? Well, we look at earnings. We want to make sure that the company's profitable. We want to make sure the company's being run efficiently. We look at companies' debt as well. We want to make sure it's not over leveraged, because if the company has too much debt or it's unable to make its interest payments, creditors might come in and say, you need to stop growing the dividend or you need to cut the dividend, particularly because a lot of bond offerings have debt covenants which limit a company's ability to grow their dividend. So we want to make sure that if the company does have debt, that's fine as long as it's at manageable levels. And so let me go back. Oops, let me go back here. I'm using my mouse here. So let me talk about some other characteristics we seek in the dividend screen as well. So beyond just favorable dividend characteristics, we want stocks that are growing. They have above median profitability, meaning they earn more than their industry peers, and they have qualified dividends. So we avoid REITs, we avoid master limited partnerships, we avoid business development corporations, because we want dividends that qualify for the reduced 0%, 15%, and 20% tax brackets. Now, nothing wrong with an MLP, nothing wrong with REITs. With MLPs, you do run into some complexities in terms of how the distributions are handled from a tax perspective. So we want to keep the DI portfolio tax simple. With real estate investment trusts, they're typically taxed as ordinary income, not qualifying for those reduced tax rates. So that's why we don't hold those. Now, as far as why we focus on dividend growth, a simple reason is that the dividend growers have outperformed over the long term. So here's a chart from Ned Davis and Hartford Funds. And what it shows you is that $1 invested in S&P 500 dividend growers, so companies within the S&P 500 that either grew their dividend or initiated a dividend. If you build a portfolio and you just rebalance it every year, that portfolio, $1 in 1973 would be worth $14,118 at the end of 2023. So $1 turns into $14,000. Not too shabby. That same dollar invested in non-dividend paying stocks, means companies that do not pay a dividend, would only be worth $843. So a huge difference, $14,000 versus $843. I think it's pretty obvious which everybody would have. But what's interesting, if you bought a portfolio of companies that cut their dividend or suspended their dividend, those stocks really didn't return very much. $1 invested in 1973 in a portfolio of companies that either halted or cut their dividend would only be worth now $73. You might have done just as well owning a savings account than holding a portfolio of dividend cutters. What I like to tell people, when a company cuts or suspends its dividend, typically it's a sign you should run, not walk away. Typically it means there's a problem with the company. Now, there can be unusual events such as the COVID pandemic, but in general, companies that tend to cut their dividends tend to have other problems going on. And I want to show you one other slide showing about the performance of all the strategies here. Actually, I have it in my chart here. But one thing I do want to point out here is that when you look at the performance of DI strategies, I think it's important to realize these strategies are always dependent on market conditions. So right now, we're in a market environment that very much favors growth, and particularly technology growth. You know, there's a lot of enthusiasm about AI going on right now. That's growing a lot of chip server, a lot of data farms, a lot of growth in chip companies, a lot of innovation going on. That's the current market we're in. And it doesn't matter what strategy you're following. If the market's following a different strategy, you're going to have some short-term underperformance. So if the market's favoring growth, right now you're seeing dividend strategies not do so well. You're seeing value strategies struggle. You're seeing small cap strategies struggle. But it's important to realize we've been through this before. If you go back to the late 1990s, it was all about tech. It was all about growth. Value managers were struggling, turned a corner to 2000s and to the aughts. All of a sudden, everybody loved value again. So these styles do go through periods where they're in favor and they're out of favor, and it's very hard to time the shifts. But investors who stick with value strategies, investors who stick with dividend growth strategies over the long term tend to be really well rewarded for their patience. So it's always important when you look at a strategy, consider the broader market environment, because there will come a time when large growth is going to be out of favor. Do I know when? I wish I did, but it will happen. The pendulum in the market will swing to one direction, sometimes too much in one direction, stay there for a while, and go back. And what we tend to see over the long term is that the average relationships in the market tend to hold up, meaning that we tend to see dividend growth do well over the long term. We tend to see value do well over the long term. But these strategies do require some patience. So let's talk about the performance of the DI portfolio in 2024. Here's our returns here. So the DI portfolio lagged S&P 500 because, again, the S&P 500 was driven by the small number of stocks. What's interesting is that over half of the S&P 500 stocks, so 251 out of the S&P 500's 500 stocks, returned less than 10% last year. So if you remember earlier, I showed you that chart about how the S&P 500 very much outperformed the S&P 500 equal weight. Here's why. Over half the index didn't even gain 10%. And in fact, over 20% of the stocks within the S&P 500, meaning 100 of the S&P 500's 500 stocks, fell by more than 10%. So when you look at those headline numbers and you think, wow, the S&P 500 did really well, it's kind of like a duck. You're seeing something being very calm above the surface, but below the surface, there's a lot going on. That's what we're seeing right now with a market breadth, where you have a small number of stocks doing extremely well, several stocks doing okay, nothing wrong with a 10% return or 8% return. And you do have a large number of stocks that did pretty poorly, in this case, losing more than 10% or more. So again, realize that what you see in the headlines is not always necessarily what's truly going on in the broader market. So here's the DI's portfolio. Here's the DI's returns since inception. In the DI portfolio, because we focused on higher income and incurring less volatility, we've gotten a lot more income return than the market has. Now, we have lagged on a price return basis, particularly when you look over the latter part of the last decade, and obviously this decade as well, where there's been a huge favoritism towards large cap tech, which not really a big dividend growers. We did have Apple in the portfolio previously. We saw it because of valuation, and obviously Apple has gone on to do even better after we saw it for valuation. But again, these returns have been hurt by the market's growth performance. What you don't see in these numbers is that the DI portfolio outperformed the broader market in 21 and 2022. So when you have those more volatile years, particularly in 2022, where we saw growth really struggle, so S&P really pulled back, the DI portfolio held up better. So it is a more conservatively managed. It's a more conservatively managed portfolio. It seeks more income, and we do believe that over the long term, dividend growth is going to power these stocks higher and close this performance gap. Now, in terms of yields on the DI portfolio, 18 of our 24 stocks yield more than 2%. Pfizer in our portfolio actually has let me go up one more slide here. I'm actually skipping slides here. So here's the yields of the stocks in the portfolio. So as I was saying before, 18 of the 24 stocks on our model portfolio yield more than 2%. Pfizer holds the highest yield at 6.3%. IDEX Corp has the lowest yield at 1.3%. The markets we said measured by the AAII yields 1.1%. And as you can see in this portfolio, most of our stocks yield somewhere between the 1.3% of IDEX and about 3.3%. We do have a few stocks that yield more, but because the market valuation has gone up, it's harder to find stocks with yields really above 3 or 4%. There are some. We recently added CME, which has a very high yield because it pays a special dividend, but by and large, it's hard to do this. Now, in terms of top performers, let me go back to the slide. Even still, with dividend growth, even as a more conservative strategy, you can still have some stocks are delivering very strong gains, even in years when non-dividend stocks are favored. You can see here, we have Allstate in the portfolio for quite a while. It was up 43.7% from the time we purchased it to the time we sold it this past November. We still hold BlackRock. That was up 29% last year. You can see Cummins. That was up 26%. Until we sold it last year. And then we still own Tractor Supply. That was up 24.9%. And what that 24.9% doesn't also tell you is that Tractor Supply has been buying back its stock, and it also just raised its dividend again. So there are dividend paying stocks, and there may not necessarily be the ones you typically think of. As you can see here, we actually do have a mix of industries here. We have industrial, we've got retail and Tractor Supply, more of an agricultural type based retail, and obviously financial stocks as well. So you can actually build a diversified portfolio by using dividend paying stocks. Now, in terms of transactions, we do try to monitor transactions. We try to keep the number of transactions low, but when a stock does violate our sell rules, we'll move to sell it. Our most recent addition was the Toro Company. Many of you might be familiar with Toro for their lawnmowers. Some of you might actually own a Toro lawnmower or another Toro product. Its big business actually comes to the commercial side, commercial landscaping, their irrigation, golf courses. We recently added that stock in November. It replaced Allstate. Toro's raised its dividend for 17 consecutive years. We've also done some reinvestments. Our reinvestments were in Tractor Supply last year, Quest Diagnostics, and also Nike, the shoe company. Nike recently replaced its CEO. He's taken the company on a big overhaul. He wants to basically bring Nike more towards its athletic footwear roots. So we're looking forward to see what he can do with the company. At the end of the year, in terms of stocks held in the portfolio that meet our initial criteria for purchasing, it's Nike, it's EOG Resources, an energy firm, and Toro, for those of you who are interested. So let's move on to the outlook here for 2025, and what we know. And why I think there is some optimism, even though we did not get a Santa Claus rally. But I will say right now, it does look like we're going to be up for the first 5 trading days of January. There's an old adage, basically, that as goes January, as goes a full year, as go the first 5 trading days of January, so it goes a full month of January. Now, again, economically, there isn't a reason why this happened. Some people make arguments, but there does tend to be this correlation between what happens in January and what happens the rest of the year. So take it as a good sign, not a guarantee, just take it as a good sign. One more thing you could put in your possibly the market will be up bucket. But so what do we know right now? There are some reasons for optimism right now. Stocks tend to rise during the first year of a presidential term, and it doesn't matter if it's a Republican or a Democrat president, they tend to rise in their first year on there. S&P 500 earnings are projected to grow. LSEG says 14%, S&P 500, S&P Dow Jones indices, they say slightly lower, but S&P 500 stocks are still projected to grow. The U.S. economy is continuing to grow, and we have seen inflation moderated. Granted, inflation is probably a little more sticky than what we'd like to see. We certainly have not seen those prices at the grocery store come down, but inflation relative to where it was, particularly say in 2022, it has moderated. The other thing is we're coming off of 2 consecutive years of 20% gains. And I was curious about, well, how frequent is this? So I actually ran the numbers. So since 1926, large cap stocks have gained 20% on at least 2 consecutive years, 9 times. They've actually had back-to-back years of plus 20% gains 8 different times. And then for about a period of 5 years in the late 1990s, as you can see this slide, it rose by 20% over and over and over. Now, what's interesting about this is that returns following these periods, it's been mixed. So you might say, oh, the S&P 500 rose by 23% in 2023. It rose by 25% in 2024. I think it's going to go down. That's too much. It's really been a coin toss. Half the time the S&P 500 has gone to grow more that third consecutive year, and half the time it's dropped. So there's no correlation. And for those of you who want more detail about this, in Thursday's Investor Update commentary, I'm actually going to delve deeper and I'll actually talk about each of these individual periods, kind of get a sense of what happened during that time and then what the S&P 500 did afterwards. But it is interesting that when you see this, that sometimes people want to look for a pattern and there isn't. And I do think there's value in knowing that even though people want there to be a pattern, sometimes there just isn't. And that's what we're seeing here. Just because the market's been up 20% for 2 consecutive years, it doesn't really tell us anything about how the market's going to do this year. The other thing is everyone's watching, obviously, is interest rates. What is the Fed Reserve going to do this year? The question is, we don't know. That's the honest answer. You can see right here what traders are pricing in. So this is from the CME's FedWatch. You can type in Google your search engine of your choice, just CME, Chicago Mercantile Exchange, FedWatch. You can see this. What this does is it charts the expectations of Fed fund futures traders. So as you look at the Fed fund futures traders, and it's saying what type of interest rate cuts are traders pricing in right now. And as you can see from this chart, maybe 1 rate cut, maybe 2, an outlier, possibly 3. Again, and maybe they won't change. What I will tell you is these interest rate expectations are very much subject to change. So right now, you're looking between possibly 1 to 3 quarter-point interest rate cuts, and that's about it. But there's also about 13% of traders who think the Fed's not going to cut rates at all. So a more cautious outlook on Fed easing. But again, these data are subject to change. And I think we'll have to see how inflation breaks out over the course of this year and whether or not it continues to trend down, which is what the Fed likes to see, or whether it stays at current levels, which may cause the Fed to hold off on further cuts, which again creates more competition on the yield environment. But if you're going solely for yield by looking at bonds or money market funds, you're missing out on the capital appreciation that buying dividend stocks provides. And there's nothing wrong with having an allocation to bonds or cash in your portfolio if it's part of your allocation strategy. But if you're desiring long-term growth, or if you're long-term investments, you want to invest in long-term assets such as stocks. Now, of course, the other thing though too is this going to be the comeback year for value strategies? As you can see on this chart, value is unusually undervalued relative growth. So if you look at the PEs, growth stocks have normally grown at, and if you look at the PEs that growth stocks had typically traded at, and you look at the PEs value stocks have typically traded at, there's a big gap in those valuations relative to historical averages. If there's a swing back towards the typical relationship between growth valuations and value valuations, that's going to send value stocks rising considerably. And because DI has a value approach to it, it should benefit DI really well. Now, I do expect this reversion to the mean to occur, this reversion to average. But again, the timing is always the big question. And the reason why there's a common phrase in the markets about reversion to the mean being a pain, meaning reversion to the average, is that we never know exactly what's going to happen. Mr. Market can stay out of whack for longer than we have patience. But also when it does happen, it does tend to happen very quick with a lot of fierceness. And if you're saying, I'm going to stay out waiting for this shift to happen, you're likely to miss the move because it tends to happen pretty quickly without warning. So it's a good outlook for value, but again, with that uncertain timing. And I do want to point out, because I know I've used the word uncertain several times here, but I do want to emphasize that every market strategist out there, every market pundit out there is operating with a cracked crystal ball. If you go back to one example I love to use, you go back to 2019, even in late 2019, some people were saying either worry about the pandemic or saying, well, maybe the pandemic might cause some disruption. You weren't hearing people even back then saying there's going to be a bear market and a kind of deep recession in the US. They weren't predicting it. So when you look at forecasts, always want to take them with a little bit of grain of salt. So what about the DI strategy? What are we seeing for this? Well, before I get to that, let me just address political uncertainties. And I did have to update the slide actually yesterday after Justin Trudeau in Canada stepped down. We are going to a period of political uncertainty. Obviously we have a unified government here. There are questions about how unified the Republican Congress is going to be here, whether the moderates and some ultra conservatives can come to agreement on legislation. But you look across the world, again, Canada, France, Germany, South Korea, you're seeing political uncertainty there. And not to mention, obviously, the collapse of the Syrian government in other areas. So we'll have to see how that plays out globally. Trade war. President-elect Donald Trump, soon to be sworn in as a president again, he's been very verbal about wanting to implement taxes. Wanting to implement tariffs. He wants to cut taxes and implement tariffs. I want to be clear on that. But we'll see, do companies retaliate, and do we see a trade war developing as a result of these tariffs? And then also the tax legislation. One of the aspects about the Tax Cuts Jobs Act, the TCJA, is most of the provisions that are set to sunset at the end of this year are actually oriented towards individuals. The corporate tax breaks are largely going to remain the same. So the question is, what happens to the individual tax breaks? There's a large desire on part of Republicans to keep tax rates low, but there's also deficit hawks in the party as well. And the reason why I bring up the Republican Party is not for any political reasons. It's that the Republicans hold the majority in the House, they hold the majority in the Senate, and they can pass a tax bill on reconciliation. That is how the Tax Cuts and Jobs Act was passed. That is how the IRA Act by the Democrats was passed. So they don't need Democrats to support the bill to pass through a tax bill. So the question is, if it is a party line vote, what are they going to actually include in terms of tax breaks? What tax breaks will they actually make go further? What will they rein back in? I don't know. And we all know they do favor lower taxes, but we'll see. And do we get to the point where it gets to late 2025 and we don't have tax legislation passed yet? That is also a possibility as well. So we know tax law now, but there is uncertainty, obviously, for next year. Now, in terms of DI portfolio changes, the one stock we're watching right now, probably closely, is BlackRock. It's done very well for us, but its current yield of 2% is just above its 5-year average low of 1.9%. So if you look at the range of high to low yields where BlackRock has traded over the last 5 years, that lower level is 1.9%. So if the stock fell below that 1.9% yield, it would be a candidate to sell the stock. Now we will see the 5-year average yields shift a little bit because what happens is we always look over the last 5 calendar years. So we're adding 2024 and we're essentially dropping off 2019. So 2019 falls off. The 5-year period we're looking at is 2020, 2021, 2022, 2023, and 2024. So that annual shift can affect the dividend yields, and we'll reevaluate the stocks as we go forward. I will say BlackRock is due to announce a dividend hike within the next month or two, so we're going to take that in consideration as well. So let me talk a little bit about the DI portfolio, some of the key features you have in a DI portfolio to give you a sense about what's in there and how we look at stocks. So first of all, this is our dividend portfolio. We hold 24 stocks that are trading at attractive dividend valuations, attractive yields, attractive valuations, but they're also growing their dividends. And we alert subscribers before we make any changes to the portfolio. And as you look at the portfolio, you again can see we do have a mix of industries in here. We have utilities, American Water Company. We have healthcare and Amgen, CME Group and financials, Eastman Chemical Company. So we do vary by industry. We do take into account allocations. And in the addendum to the slides, which you can download, I actually show you a breakdown of our full allocation by sectors. We also have a dividend screener. So this actually screens on those dividend pillars I told you about before. And the nice thing about this dividend screener is it's not just limited to the 24 stock DI portfolio. It looks at all dividend paying stocks listed in the US. And if you have a My Portfolio set up at AAI.com and that My Portfolio is available to all members, you can actually go on here. If you go on there, if you see this button, this middle brown button that says Load Portfolio, if you have a My Portfolio, you can actually load your My Portfolio into the dividend screener and see the dividend grades for that. Now, this is part of the DI service. We also have the DI list. So these are stocks that meet our initial criteria for being added to the portfolio. This is updated after the close of every market day. And it's stocks that are candidates, our first candidates when we make an addition to the DI portfolio. And these provide additional ideas for dividend-seeking investors. So you can see some of them in there. With CNA, it does pay a special dividend. We've looked at it. EOG, we already own in the portfolio. Brown-Forman, I will point out that's the alcohol company. We've passed on that because it does have a dual share class, so we do try to avoid stocks with dual share class on there. You can see Nike on there, which we do hold in the portfolio. Qualcomm, the chip company, that's a recent addition to our D ideas list. I've saw it appear within the last week. I have not looked at the stock closely, but you can see there is a mix of stocks on the list. We also have a dividend grader. So what this does is a part of the DI service, and it gives you data on to analyze a dividend stock to determine whether or not it's fairly valued or expensive. If it is growing its dividend, whether it has capacity to continue growing its dividend, and basically how's it rank against our pillars. And so we give you a lot of data, a lot of detail about the stock. So if you want to actually see, okay, what's behind these grades for each stock, so you can look at each individual component of the DI portfolio. And I do want to remind you, I have included additional slides and an addendum to go over some of the things I briefly mentioned on. I've also included some notes in the slide as well. If someone has some questions or you missed something I said, it is in the portfolio itself. But I've been doing a lot of the talking, Jenna. Are there any questions that have come through that I could possibly answer?
Yeah. So before we go into the Q&A, I did want to because I've been posting this, a few things in the chat, but I wanted to verbally just before we get into the nitty gritty is I want to share a bit of information about our special webinar week discount that we're giving to exclusively to attendees. So you can get a special discount on a 1-year subscription to any AAII premium newsletter featured in this week's events for just $97 when you use the promo code webinar50 at checkout. And then obviously this is a limited time discount and it's just exclusive to webinar attendees, like I said, and it's valid through January 10th at 11:59 p.m. So it'll be valid all week as we're doing each day we're doing different model portfolios. And then all you have to do is just simply visit AAII.com/webinar week. to learn more and purchase. And then you must, just as like a friendly note, please use the website URL provided to receive your discounted rate, so you can actually put in that checkout code. But yeah, let's get into some before we I want to get into some Q&A and stuff. I know we've gotten a lot of questions coming in. I really appreciate everybody submitting those. So let's take a look. Okay, I think before I did have one question for you, Charles. I'm asking this all week to every single analyst that we have. So I wanted to ask, what is the one thing that surprised you the most from 2024 that impacted the DI portfolio?
I think it was just the concentration in the S&P 500, how it was already high, and it just got more intense, and how much after a big year in the stocks, you kept seeing it grow more and more intense. And I understand, there's a lot of growth in AI, a lot of demand for AI. I've been using it some, but it surprises me that things aren't spreading out. People aren't looking at these valuations that it does seem to be. People are willing to accept higher and higher valuations, even though when you look at a company, say like NVIDIA or Apple, you start running the laws of big numbers where 10, 50% growth is a lot of dollars and a lot of product they have to ship. So that's probably the one thing I would say has surprised me, is just how extreme the concentration in the S&P 500 has become among its top 10 holdings.
That makes sense. And so we got a question that I think plays off. You were talking about how the political impact, will or may impact, just dividend stocks in general. So I wanted to ask you, is there, how do dividend stocks typically perform during presidential years as a whole? Is there any data on these types of trends?
I have not seen any data regarding how dividend stocks themselves perform during the presidential cycle. That's a good question. I have not seen anybody actually talk about it, so I can't say. In general, I would say they probably do follow the rest of the stock market, tend to be, up on average during the same year. You see most stocks are being up, but in terms of how dividend stocks specifically perform, no data on that I could even think of referring somebody to.
It makes sense. And we got quite a few people that I think are, so we have a pretty good mix. I can tell that we have, current DI subscribers, and then also, just AI members who are maybe interested in dividends or looking at the DI strategy as a whole, and then also non-members as well. So I think this came from either a non-member or someone who doesn't have that isn't subscribed to DI. But what do you think? There's one thing that is in your mind that the DI strategy does really well compared to other dividend-focused strategies?
I think, that's a good question. I think one of the things on there is just, I think the way we consider growth and valuation. We really do take a look at whether the company has the ability to do dividends, but our valuation strategies is based on the idea of Geraldine Weiss. And I think we do a good job of being very formulaic in terms of our approach. And Weiss herself was a very disciplined, quantitative investor. She ran a dividend newsletter in the 60s and 70s. She actually passed a couple of years ago. But one of the things she came with the idea of this range of yields, that there's a yield that's low enough that if it gets onto that level, it's telling you it's a danger sign. And if it's high enough, it's a sign that, this stock is way undervalued. And just having that discipline to go through and let the numbers drive your decisions. And it's something I think at AAII we do really well, not just with DI, but with all our portfolios. We try to be quantitatively based. And I know a lot of times people like stories, but when you follow quantitative strategies, it really takes the emotion out of the investing decisions. And I think it leads to a more disciplined approach. And I think letting the numbers guide you, it really applies no matter what type of strategy you follow.
Couldn't agree more. And kind of playing off of that, we had a member who asked, do you ever add or remove a specific criteria from the DI strategies rules? Why or why not?
We do. We tweak it over time, and we do that with all our strategies. It's usually we do it when there's new information that comes available to us. If obviously we see something that just clearly isn't working, we find something's too restrictive that we're doing, we'll tweak it then. We tend to more often just make small tweaks than big tweaks, but probably one of the biggest changes we made to the DI portfolio, I'd say since we launched it, was probably the introduction of the strength, quality, and value grades. It just kind of allowed us, I think, to more quantitatively look at the stock, but I think it also helps subscribers to actually look at the stock as well, understand why it's attractive and why it's not attractive, and why it may not be attractive anymore, or why some other stock that they own or are interested in or looking at that's not in a DI portfolio, why it may or may not be an attractive stock.
That makes sense. Actually, we got a question earlier when you were talking is how are the dividend grades different than the AA plus stock grades? Can investors use both together, or should they use one or the other while they're vetting certain stocks for their portfolio?
They can be used both together. The difference is, particularly if you look at the dividend like strength grade, that's specifically looking at what's the company's ability to pay its dividend and making sure it's not violating the dividend covenants. Versus if you look at the A plus quality grade, that looks at about 8 different components. Buyback yields included, but it's really looking at a company's overall strength. So the difference is the dividend grades are very specific to dividend investing strategies. What you could do is you could use the DI grades, the value, the strength, and the growth grades, particularly for the dividend portion. And then maybe perhaps you might want to look at you can look at the growth grade to make sure there's additional growth in earnings. Perhaps you want to lay over the A plus value momentum grade to see if there's a stock have momentum in it. Are they plus earnings estimates grades? And use that to see whether or not analysts are raising the earnings estimates. It's not apples to apples. You probably see the most overlap, I think, though, looking at the DI value grade with the A plus value grade. And similarly, when you look at the DI strength grade with an A plus quality grade, that's where you're going to probably see not absolute overlap, more similarities.
That makes sense. And speaking of when stocks are added to the portfolio or taken or removed from the portfolio, how important is that timing? From when you send out that email to subscribers and then for them like reacting to that change in the portfolio. Should they immediately buy or sell? Should they do some of their own due diligence? What is your advice when that happens?
Yeah, we recommend doing your own due diligence, regardless of which newsletter you follow, whether it's DI, another one of our newsletters, or a newsletter run by another firm. We always suggest doing investors do their own due diligence. But in terms of acting, we suggest within a week. You don't have to, we'll release an alert Friday evening, so you have all weekend to look at it, to do your own research, consider what's the best move for your portfolio. But you don't have to place an order first thing Monday morning to buy the stock. You kind of see how it's trading. If the market opens really strong on a Monday, maybe you feel better waiting to see if the stock price comes down. We're not strict about what day we buy the stock before they replace the portfolio. We usually do in the early part of the week, but we do take a look. But my experience is that it's kind of hard to tell whether the stock's actually going to go over the course of the week, but we're really not buying the stock for short term either. So, maybe you buy the stock and you realize, oh, I could have gotten it 2% cheaper. Well, if the stock rises 40, 50, 60, 70% from there, that 2%, less that you could have gotten it for is really not going to make a big difference. And we think because we follow a longer term approach towards holding stocks and try to limit turnover, the short-term timing component really kind of gets washed over with the overall market moves over a period of several months and really over a few years or more.
That makes sense.
We've held Pepsi, for instance, since we launched the portfolio in 2012. So, if you waited a week to buy Pepsi, over 12 years, it's not going to make a big difference.
No, that's correct. Actually, speaking of, like portfolio turnover and rebalancing and things like that, do you rebalance the portfolio if a stock becomes too large a portion of the portfolio? If so, what does that kind of criteria look like?
We do rebalance the portfolio. It's an interesting question. So what we do is we look for stocks that are trading 2 times above the average of all stocks in the portfolio. So I know that sounds a little complicated. So let me explain something very simple. Assume the portfolio had just 20 stocks, not 24 stocks. That would mean each stock has an average weight of the portfolio of 5%. If they all say we had $5,000 allocated to all 20 stocks. If one stock's weight goes from say 5,000 to 10,000, all of a sudden its weight would be 10%. So then all of a sudden it'd be double. Then all of a sudden you're looking at having 10% versus 5%. So when we look at 2 times weight, means basically it's double the weight of all the other stocks. So in that case, we would take that $10,000 and narrow down the stock close to $5,000 level. So that's kind of the number we use. We use 2 times for the DI portfolio because it's a little bit more conservative. For VMQ, we use 2.5 times. And there's nothing magical about 2 times the average value of portfolio or 2.5 times the average value of the portfolio. If you want to be more conservative, you could say, I'm going to rebalance my stocks when any one of them becomes 1.5 times, their position becomes 1.5 times as large. Or if you want to be more aggressive, say 3 times. Really where the benefit comes from is you have this number saying, here's the average value of every stock in my portfolio. And if any stock grows to be X number of times that average value, I'm going to rebalance. And you can set the number as aggressively as or conservatively as you like. We found that range of 2 to 2.5 times works pretty well. Does not result in very many transactions, but it does keep us from having one stock becoming overweighted. Because what you don't want is a situation, as I showed you before with NVIDIA, where it accounted for 22% of the S&P 500 index's return. So an index of 500 stocks and you have one stock accounting for 22% of the return, that's something you really don't want in your portfolio. That's just giving you too much concentrated risk in one stock.
That makes sense. And let's see, quite a few questions coming in here. I'm going to just take a few more and then we'll probably wrap up. Let's see. Oh, do you ever rebuy stocks that are removed from the portfolio, or if they go on to the probation, what does that time span look like before they're either removed or added back in?
Yeah, usually probation, well, usually if it's for valuation, we might wait a week or 2 usually, but we're usually, or if we think the stock's going to be pretty close to raising its dividend, then we might wait a little bit longer if we want to see what the dividend increase is, and we think the dividend increase is going to be large enough to bring the yield back up to an acceptable level. So it does depend on how close it is to raising its dividend and what we expect that dividend increase to be. But once the stock's removed from the portfolio, we would consider if it comes back again, we would evaluate it at that time, particularly if the stock was sold for a high valuation and its valuation became low again. We would then look at what's going on in the company. Has anything changed? So we're not opposed to rebuying it. It's not something we frequently do. But you know, if it's a good stock, we saw in valuation, its valuation came back down, and it happened to be on our ideas list at the time we were considering making a change. Yes, we would consider it.
Makes sense. And if someone is relatively passive in investing, are they able to follow the DI strategy, or do you have to be pretty vigilant and active to successfully follow the DI strategy in portfolio?
So last year we had out of the 24 stock portfolio, we replaced 8 stocks. So, and some of those transactions happened together. So we try to keep the portfolio pretty low turnover. We are conscious of taxes. We do realize we do have subscribers that are holding this portfolio or tracking this portfolio in a taxable account. So whenever possible, we try to realize long-term gains, but we do try to keep the level of turnover low. And as I said, we had some stocks we've held for a long while, but we will have some turnover either because there's acquisitions, because because the stock's valuation gets too expensive, or some change in the company's fundamental characteristics. But we do try to follow a slower turnover approach to the portfolio.
That makes sense. And I don't know, I know you briefly touched on the drip strategy earlier in the presentation, but how does the drip strategy work with the DI portfolio? Is there any tips or anything that you would advise someone who just got into the DI into following the DI portfolio?
Yeah, that's actually a great question. So the DRIP strategy basically is dividend reinvestment programs. And so you can actually do dividend reinvestment programs through the individual companies. Um, these days, a lot of brokers just facilitate it automatically, so you do not have to go through a separate company to do it. You can do it, say, through Fidelity. I know you can do it through Schwab. You can probably do it through some other companies as well. I think believe E-Trade does it for certain stocks. But what we do with dividends, the strategy for DI, when a company pays a dividend, we tend to allocate that dividend to cash, and then we let that cash build up to a certain point, and then we think about how to reinvest it. Now, we did switch to paper trading in October of this year with the DI portfolio, so now we're doing the paper trading. But when we were using real money, we'd watch the cash balance, and so now we're tracking the cash balance with quote unquote paper money with the intent of reinvesting it strategically. What we tell subscribers in our users guide is they can either take the dividends, set them aside for cash, and look to strategically reinvesting them in the future, meaning either reinvest them in undervalued stock or set the money aside to perhaps invest in a new stock when it's added in the portfolio. Um, if they're retirees or if there's someone else who just needs the portfolio income, they can take the dividend, spend it, use it for withdrawals, or alternatively, they can directly reinvest in the stock themselves. So say I mentioned, let's say Nike or EOG, two stocks I previously mentioned, say they pay a dividend. You like the stock, you want to automatically reinvest it, you can go ahead and do that. As I said, a lot of brokers will facilitate that for you, where you just go into your broker, you set up, say, yes, automatically reinvest my dividends. You'll have to ask your broker where that setting is on their website, and then it's just automatic. So I don't think there's a right or wrong way to doing this. I think it really comes down to personal preference. But I will say, though, if you are maintaining the portfolio, you're not taking withdrawals, you do want to have a strategy for reinvesting that money back into your portfolio so it doesn't stay in cash unless you are specifically looking to fund a withdrawal, be it a required minimum distribution or a withdrawal for some other reason.
That's a great explanation. And I think the last question we're going to take, just because I don't want to run too long, is, do you recommend investing in the entire portfolio versus just picking and choosing a smaller portion of it? Is there a magic number of how many stocks that you would recommend someone getting into it if they're just starting out for the first time?
Sure. People don't have to follow a full portfolio. Um, Obviously, if you buy all 24 stocks in a portfolio, you're going to get more, your returns will be closer to what the DI portfolio
Mhm.
realizes. Uh, I would suggest someone buys probably at least 10 to 12 stocks solely because you want to get the diversification. When you buy one or two stocks in a portfolio, you don't get the diversification. And you really see portfolios doing well when you're holding a mix of companies of different industries, different sectors. And so that's a big reason why you want to hold a mix of stocks. And particularly now with brokers not charging commissions, it's easy to do. And some brokers actually facilitate
Mhm.
fractional shares. If you don't have enough to build a diversified portfolio,
Mhm.
you can go through some brokers that will allow you to buy fractional shares uh, and get it that way as well.
That makes sense. Well, thank you so much, Charles. I want to give you before we go into the outro, and I'll talk about some the rest of the week, what to expect, and then also reiterate some of our special offers that we're giving in attendees today. But did you want to have any last words and anything to give to our audience before we sign off?
Yeah, I just one thing when you think about dividend growth, you kind of think about it as really a win-win situation towards investing because when you buy stocks, at attractive prices that are fundamentally strong, you have that upside capital appreciation. But then with dividend growth, you get this income payment that's increasing every year. And if you buy stocks at a certain yield, say the yield's 2%, that yield is what your starting yield is, but every year you're going to get paid more and more dividends. So when you look at the yield based on your purchase price, that yield is going to continue growing as a dividend increases. Now, granted, the quoted yield is what someone else is going to get when they buy the stock, so that affects how it trades. But realize that even a low yield, it seems kind of low at purchase, as you hold on to the stock and as the dividend is increasing, your yield based on your purchase price is going to increase as well. So it can really be a win-win situation where you get that capital appreciation and that growing stream of income at the same time.
That's fantastic. And no, I just want to say thank you so much, Charles, for, guiding us through the DI portfolio, taking us through, the different kinds of tools that it offers, the portfolio performance over 2024, and then even giving us some insights into 2025. I know I learned a lot, and I hope I hope everyone was listening and tuning in to, get those insights. But I really appreciate your time with us, Charles, today.
Thank you, Jenna, and thank you everyone for watching. We appreciate you all being here. And again, I want to wish everyone here a happy and prosperous and healthy new year.
Yes. And if you have any questions about the DI portfolio, I know we gave a lot of information on the performance, portfolio alerts, new additions, etc. If you're just interested in, talking about billing or subscribing to another newsletter, we're always happy to help. So feel free to email us at members@aaii.com, or you can call us at 312-676-4307. And that's Monday through Friday, 8:30 a.m. to 5 p.m. Central Time. And then our special promo today allows attendees, I already kind of reiterated this, but I want to make sure, in case I missed anybody coming in late, you can get a 1-year subscription to any AAII premium newsletter that is featured in this week's events. So that includes VMQ, DI, growth, and SSR for just $97. And then when you use the promo code webinar50 off at checkout. Sorry, I apologize to everyone in advance on the screen. It is webinar50 off at checkout. And then with your subscription, obviously you'll gain access to all the valuable resources that Charles talked about, all the tools, weekly insights, weekly emails, and of course, access to the events held this week. So all you have to do is visit aai.com/webinar-week, and I put that in the chat multiple times if you want to learn more, get more information, or if you want to subscribe. And then, like I said earlier, the special webinar week offer is just valid through January 10th at 11:59 p.m. Central Time. So if you'd like to subscribe, please do so before then. And then if you'd like to attend any of the other webinar events this week, you don't have to make a purchase. They are open to everyone. So please visit ai.com/webinars to register. And then lastly, because we did receive quite a few comments and questions in the chat, this presentation was recorded and a replay will be available at aaii.com/webinars, probably either later this week or early next. And then webinar attendees will also receive an email with the link and probably towards later this week, early next week, like I said again. Then you'll also get in that email, you'll get access to a copy of Charles' presentation slides, as well as any other links to resources that I dropped in the chat or anything that we think would be helpful in the future. And with that, we wish all of you viewing good health, good fortune, and a great rest of your day. So thank you so much and take care.